Hello and welcome to the Retirement and Money Show. So, I was recently helping someone who'd been self-employed for 15 years. She was 52, earning good money, but had never set up a pension. So what we did is we worked through it together, and the good news is she now has a pension growing tax efficiently. So, if you are self-employed and keep putting this off, you're not alone. But the reality is every year that you delay is costing you potentially thousands of pounds in lost growth. So in this video, I'm going to show you exactly how to set up your pension step by step. So in this video, I'm covering 4 key areas. Number 1 is why you actually need a pension when you are self-employed. Number 2, the 3 main pension types and which one is likely to suit you best. Number 3, the exact setup process from start to your first contribution. And then number 4, how to get free money from the government through tax relief. So by the end, you'll know exactly which pension type is right for you. You'll have a clear checklist to get your pension set up this week, and you'll understand how to claim the tax relief that you are entitled to. So my name's Zach Hussain, and I've got over 25 years experience of helping people plan for their retirement. When I speak to self-employed people, one of the questions I often get from them is, well, why do I need a pension? See, there's a reality that most self-employed people don't always want to hear, and that is if you're relying on the state pension alone, you're in trouble. See, the state pension is currently £12,000 a year. Now, in January 2026, it was confirmed that from April 26, it's going to go up to just over £241 a week, which is going to work out at just over £12,500 a year. Now, think about your current lifestyle and what that actually covers. Because the personal allowance is still frozen at £12,570, and your state pension now leaves you with only £22 of tax-free room for the entire year. See, here's the scale of the problem right now. Only about 1 in 5 self-employed people are actually saving into a pension. If you compare that to employees, where 8 out of 10 have workplace pensions, that means that there's a massive gap, and it means millions of people are potentially heading for trouble. But here's the thing employees have that you don't. And that is that they get auto-enrolled into a workplace pension as soon as they start working. And isn't the case for everyone, but it's certainly the case for the vast majority of people. That means that their employer contributes money on top of what they put in. So by the time that they retire, they've built up a pot without even really thinking about it. But the reality is that you don't have that safety there. Nobody's doing this for you, so it falls entirely on your shoulders. The good news is, once you understand how it works, it's not complicated, and the tax benefits actually make it better than most saving options. So let's look at the different types of pension that you can choose from. This is where most people get stuck because you can't decide which is going to be the right option for them. So I'll try and make this as simple as I can. So there are 3 main pension types for self-employed people, and each one of these works slightly differently, and each suits different situations. So firstly, there's the personal pension. These are run by insurance companies, banks and building societies. What you do is you pick from a range of ready-made investment funds that they have available. So it's generally a hands-off approach because they are the professionals and they manage everything for you. So this suits you if you want simplicity and don't want to make any investment decisions. Second, there's the stakeholder pension. So these are government cap charges, so fees can't go above 1.5%. And you can start with as little as £20 per month. And here's the key part for self-employed income. You can pause contributions anytime without penalties. So this suits you if your income varies and you need maximum flexibility. And then third, there's the SIP, or otherwise known as a self-invested personal pension. What this does, it gives you much wider investment choices. So you can invest in individual shares, funds, bonds, even commercial property. And if you really wanted to do so, you can use your pension fund to individually buy and sell stocks. This suits you if you want control, but more importantly, have investment knowledge and feel comfortable making these investment decisions. So now that I've explained all that, let's go on to the actual setup process for setting up a scheme. When I talk to self-employed people about setting up a pension, I often get some groans back, and I ask them why they're groaning so well. Surely the setup process is going to be long, it's going to be arduous, it's going to be difficult. But the reality is it doesn't have to be, because in my experience, setting up your pension takes less time than most people think. So here's what happens from start to finish. So step number 1 is to choose your provider. So compare a few options and look at 3 key things. And they are, what are the annual fees and their fund charges? What investment options do they offer? And also what online tools and support do they provide you to help you with your decision making and to manage your pension? Step 2 is to gather your document. So you're going to need proof of identity like a passport or a driving license, and you'll need your national insurance number, and you'll need to provide your bank details for contribution. Then step number 3, well, quite simply complete the application form. So the reality is most providers let you apply online in about 15 minutes. So you'll choose your investments, choose how you want to have your money invested on a monthly basis, and you'll do that during this step. Many will offer you a default fund. So if you don't want to make a decision, you can just pick that and then they'll invest it for you. And step number 4 is to set up your contribution. So you can pay monthly by direct debit or regular saving, or you can make lump sum payments when you have some spare cash. Now, most self-employed people do a mix of both approaches in my experience. So, you can pick whichever's best for you. Moving on, here's where it gets really good, and here's where you can access some free money. Getting tax relief is an area that I find can be a bit confusing for some people. Certainly the part when I speak to self-employed people, they don't fully understand. The reality is, because they don't understand it, it's costing them thousands of pounds every year. So when you put money into your pension, the government tops it up. So for every £80 that you contribute, they add £20 automatically. So that means £100 goes into your pot, but you only paid £80 for it. So that's effectively a 25% instant bonus on everything that you save. So let me show you how this actually works in practice. So you contribute £200 per month from your bank account. Your provider then claims £50 from the government for you. So therefore, your pension receives £250 every single month. What does this mean? Well, it means over a year, you're putting £2,400, but your pot actually got £3,000 into it. So that's £600 of free money just for saving into your pension. And if you're a higher rate taxpayer, earning over £50,270, it gets even better. So in January, the Chancellor's directive note that while sole pensioners may be exempt from filing, your self-employed status means that you're already in the self-assessment system, making it easy to claim that extra 20% relief. So that £100 in your pension actually only costs you £60. So for irregular income, here's what works well. Contribute what you can when business is good, and when cash is tight, pause your payments, and you can normally do this without any penalty. And then catch up with lump sums when your money starts to flow again. So hopefully all that makes sense. Now moving on, let me give you some action steps to help you get this done. Now here's what to do next to get your pension set up. So first, decide which pension type suits your situation best. If you want hands-off simplicity, go for a personal pension. If you need flexibility with irregular income, consider a stakeholder pension. And if you want investment control, look at using a SIPP. Number 2, compare at least 3 providers before you choose. So look at their annual charges, because these charges can add up into a lot of money over the decades. And check what investment options that they offer, and see how their online platform works for managing your account. And you can do this by usually going onto Google and having a look at various reviews online. Third, to gather your documents so that you are ready to apply. So as I said, you'll need your ID, your national insurance number, and your bank details. Most applications take about 15 minutes to do online. Number 4 is to set up your first contribution, even if it's small. Starting it is far more important than just waiting, because everything will have a huge impact over the years. You can always increase it when your income allows, and you can decrease it if you need to. And number 5, mark your calendar to review this every April. And check if you can increase contributions after a good year. And of course, make sure that you're claiming all the tax relief that you are entitled to. So I hope all this helped make sense. If you have any comments, please leave them below. But if you need any more information, you can visit our website, financialeducation.co.uk. But if you did find this helpful, please do give the video a like and do subscribe to our channel, where we have a lot of content to help you plan for your retirement. So finally, good luck and goodbye.